Hi, everyone. Thank you for joining us today on another iteration of the Market Pulse. You have myself, Bepin Serraj, as well as Mike Sorrentino on the call today. The theme for this week, it's finally over. And as a
Thank God.
Michigander living in a swing state, we are so glad to have our phones stop buzzing. I mean, I don't know how it was for you out in Tampa, Mike, but over here it got um, insane. I think every time my phone would buzz, I would just immediately think it was a political talk. I stopped answering the phone to any unknown number. And I actually missed some pretty important calls just because I assumed they were political. But I can, for one, can say that we are so happy that we get past this now and get back to normal. But moving
This is
forward
not
with
petty.
that, just some disclosures. This is the quote of the week here. Politics is the art of marshaling hatreds by Charlie Munger. And that's honestly what it is. A lot of from both sides is just rather than talking about what you're going to do, most of the time it's talking about how bad the other guys are and how bad they're going to be for you. And we're just happy that we can move past this and probably have to readdress this again in 4 years. But for now, we get some reprieve. And as you may have noticed in the market has been very happy since the election has been announced, and now that we know the winner. And one of the main reasons for that, in our opinion, is that the market likes certainty. They don't like being on edge, where they're thinking anything that happens tomorrow can change our entire regulatory system. And once they know who's going to be in office for the next 4 years, they tend to get back to business, and looking at this chart below, it's showing the returns of the S&P 500 before and after the election. In the 3 months and 1 month leading up to the election, it's been historically negative. But looking post-election, in the 3, 6, and 12 months, the returns have been quite healthy. And looking at these great returns, we would expect something similar coming forward here. We've already seen 3, 4% in the S&P in major markets just 2 days after. So it's looking like we're all looking for the future now, and politics is kind of off our shoulders, and we know what to expect going forward. And if you're not just looking at politics, if you actually look at just what the next historically what the next 8 months have looked like, or the next 6 months have looked like in the S&P 500, the chart you're looking at here is showing you average returns over 6 month windows from 1928 all the way to this year. And historically, we have just left the worst period in the market. And that would be that May to October stretch that's boxed in red there for you. The average return during that time period was the lowest on record, 2.14%. And it was only positive 66% of the time. Now, heading into this next period here, the period that we're in right now, the returns have been the highest on record, and you've had a positive return 71% of the time. Now, we're not saying history may repeat itself here, or it's going to be exactly 5 or whatnot, but we do think that heading into this period, we like our chances of seeing some positive returns in the stock market.
Yeah, and talk about positive returns, talk about the stock market. Unfortunately, everybody, I was the one that drew the short straw today, and I have to talk about the aftermath of the election. And look, I mean, there's a lot of pep talks going out there right now and a lot of celebrations on the other side. I would say that there's going to be people out there right now that are happy, people that are sad, particularly, like I said, Bepin in the swing state.
Yeah.
What I want to do is for those who think that the market is going to rip simply because Trump won, and those who think the market is going to crash simply because Trump lost, do me a favor. Take a look at the chart here. This is the S&P 500 over the last 10 years. Do me a favor and pick out the day. You know what? Not even that. The month, the week. You tell me the time when Trump won in 2016, and then pick out when Biden won in 2020. Do it. Can you see it? Where is it on the chart? Because I can't. There's a lot of ups and downs along the way, a ton of ups and downs. But at the end of the day, a $10,000 investment rose up to about $29,000 along those 10 years. Both administrations, two very different election outcomes. Oh, actually, 3 now, speaking.
Mm-hmm.
Okay. So my point here is that if it feels good or bad right now, all right, I don't want to be the buzzkill, but it kind of just disappears. All right, it disappears and all the noise and all the other things that are happening that drive the market up and down over time. The only trend that matters is from beginning to end. And you might be saying, well, that's just 10 years. Well, let's go ahead and extend it out a little bit. Let's go out and look at the last 25 years. Okay, way more elections in there. We've had some crazy ones. Remember Al Gore and George Bush?
Yeah, the
Right?
Florida machines. Yep.
Florida machines, the Chads. I remember the Chads. All that craziness. All right. This is a much smoother line, though, in many ways. Pick out a single election day. I challenge you to, or an election week, because sometimes we don't figure out what happens the night before. Right? Pick out one. I can't do it. I don't see any of them. You know, it's 25 years. We go out even further. Let's really kind of beat the dead horse here. 75 years. We've had a lot of elections, a lot since the 50s. All right. We've had a lot of Democrats win, a lot of Republicans win. Show me an observable trend of one party versus the other. Show me a single election, one election day. You can't find it. I can't see it, and I look at these charts all day. All right. I'm driving.
The only trend that really sticks out there is that the markets tend to move up and to the right.
Markets go up, and it's not because of elections. Yep. It's that simple. If your team won this week, congratulations. If your team lost, don't let it impact your thinking. It's what Bepin mentioned earlier. What's going to drive the market going forward is not the election. It's going to be the fundamentals. It's going to be the fact that our economy is growing, the fact that interest rates are coming down, which takes us to our last point of the day.
That's exactly my point there, Mike. With all this election talk and everybody just talking about who won the election or if their guy's in or their person lost, we missed one of the, or I think most market participants missed one of the biggest events of the week, which was the Fed talk, the Fed rate decision that came out yesterday.
Yeah, it was almost an afterthought. I honestly don't even know if it got any. Well, the funny thing is, it got a little bit of news coverage, and the only reason why is I think because they wanted to ask Powell if he was worried that Trump was going to try to fire him, which he can't do.
That was the soundbite that made it out of that. Yep.
Yeah, that was a big concern back in 2018 or so, and there's just no way they could do it. But anyway, we'll push that aside. Let's talk about rate expectations. This really is going to be what matters most over the next 6 months. Than who's in the White House. All right. Now, who's in the White House does matter, but that tends to be multi-years before we start seeing any real impact in the economy, good or bad. So this is way more near term. And we all knew this was going to happen. The Fed could not have been more clear that they were going to cut rates by 1/4 point or 25 basis points. If you want to get really geeky, 25 basis point cut. They did it. And look what's already happened. Look what's already happened in less than 24 hours. I've gotten 5 emails this morning about how interest rate, the yield rather, on money market accounts that we work with, FDIC insured deposits, everything across the board is already down. They didn't even wait the end of the week. All right, that's how quickly this stuff moves. So if you're sitting in cash right now, the question becomes, well, okay, but 4.5 or 4.25? I forgot what the target is. I guess I'm doing the math wrong here. Yeah, 4.5 or so.
4.25. Most of the yep. So we primarily use Flourish Cash, which you've probably already got in the email if you're using it right now. That the rates have come down 1/4%, right in line with the market.
So 4.25. So you back out taxes and you back out inflation, which I seriously doubt inflation in Michigan right now is 2%. So you do all that and you're losing money safely, effectively, because I'm not quite sure that you're keeping up with inflation. So this isn't necessarily to scare people out of cash. It's to think about what the trajectory is here, okay? And if you look at this chart, this is what the Fed is partly what the Fed has told us they're going to do in December. They're going to cut another 25 basis. Right? They told us they're going to do that, right? But past that, what is the market expecting? Okay, the market is pricing in. Look at that red box on the screen at the end of 2025. Basically, a year from now, rates are going to be around 3.5%, 3.6%.
Yep.
Okay, that is not going to cut it. Furthermore, if interest rates are going to continue to come down, there are going to be investors out there that say, wait a minute, why I need to get out of cash because cash isn't paying anything anymore. And the only reason why rates are coming down is because the economy is doing well. If that happens, that's a lot of dry powder that's going to get put into assets like the stock market, the bond market, and really anything else that's levered to growth.
No, it's exactly what
So
we've been saying for a while is look at all that money on the sidelines and when is it going to start coming in? And I mean, I think as rates keep coming down and as they keep getting emails about the yields coming lower on their high yield savings accounts, I think you're going to start seeing some people start moving some chips off the safe end and to the riskier side to really keep up with growth growth expectations. But
exactly, and I think what more than anything else is that investors, we have effectively a couple weeks to the end of the year. The Fed is going to cut one more time by the end of the year within that range. This is a call to action. If you're sitting in cash right now, now's the time to call your advisor, have a conversation. I'm not saying you need to do anything, but I think it's important to have a conversation. The options right now to move into higher yielding assets or higher growth vehicles are on the table. They're out there. We have access to them. But as the Fed continues to cut rates, those options over time are going to be fewer and fewer as we go forward. So something to think about as we close out the year. The election's behind us. The economy is moving in a good direction. Things are looking optimistic as we go into the next year. So let's all take a big sigh of relief. We don't have to worry about election talk for another, well, I'd like to say 4 years, but realistically, we have midterms in 2
no one
years.
cares about the
So,
midterms, man. It's a every
yeah.
4 year election cycle, but
We can at least relax for a year because somehow the presidential election, I feel like it's going to start about 12 to
yeah, they
18
start
months from now.
campaigning earlier and earlier every year now. But yeah.
Yeah, exactly. So with that, everybody, thank you for your time, and we'll talk in a couple of weeks.